Thank you, Andy, and hello, everybody. So as Andy said, we'll take you through the results slides. So can we have the next slide, please? So as Andy said, very good year for Impax. This is the results for our financial year ending 30th of September 2020. So in that time period, we had a 34% increase in our assets under management to £20.2 billion. The increase was in part due to £3.5 billion of net inflows, which was a record level. And of course, we've all been dealing with COVID-19, so the firm had a solid performance through that time period and continues to be very resilient in the context of the pandemic. And we do believe we've got very good scope for further growth. Next slide. A quick run through the numbers. So 18% increase in revenue to £87.5 million and a 29% increase in operating profit to £23.3 million. We've also, as you can see, the top right, had a very good start to our new financial year with assets under management in the first 2 months of the new financial year growing to £23.4 billion, which they reached at the end of November, so just a few days ago. And that included further growth in inflows. So we had £1.9 billion in net inflows in just 2 months. And at the bottom right, you can see that the proposed dividend per share, final dividend of 6.8 pence, will take the annual dividend to 8.6. 6.8 pence final takes us to 8.6 total for the year, which is a 56% increase on the prior year. Next slide. Just a quick snapshot of the business. So I'm sure everybody knows that our investment philosophy is that we believe that there are fabulous investment opportunities arising from the transition to a more sustainable economy. This has been our investment area for more than 20 years. And today we have one of the world's largest investment teams dedicated to this area and a total staff of just over 175. The assets under management at the end of September were very clearly dominated by environmental market strategies, but we have been growing the other 4 areas of our business quite nicely. So a little bit more detail on that to come. Next slide. If we look at the context for Impax's future, then I think it's fair to conclude that the drivers of the sustainable economy continue to strengthen. So, of course, we do have the climate change conference taking place in the UK in November next year, and that should mean that climate change is very much on the agenda in the media throughout the next 12 months. The election of Joe Biden in the US should strengthen the US policy in this area and underpin renewed corporate commitment to spending on environmental improvement and resource efficiency. And we do see around the world, for example, in the new Chinese 5-year plan, that there's parallel levels of both policy support and consumer support for these markets. That is leading to a rapid expansion in both the number and the scale of the investment opportunities for us. And we are seeing that asset allocators and owners around the world are increasingly interested in looking for opportunities in this area and backing managers with interesting approaches and strong investment processes and solid investment capabilities. So in that context, we do think that our authentic approach, our dedication to this area does put us in an excellent position to continue to expand based on a scalable business model. Next one. So as I said, we've fared well during the pandemic. Of course, corporately, we had to move to remote working very quickly back in March, and by and large, we are still working remotely. We do have 3 out of our 5 offices open for those that need to be in the office, but 90% plus of staff are still working from home. Of course, our investment performance and our clients onboarding has continued to be successful. So functionally, we've weathered the storm well and continue to be resilient looking to the near future. In terms of the investment landscape and implications for that, then of course investors have been reminded of systemic risks by COVID-19 and now looking for the read across to climate change, but also cyber risk and other systemic risks, which they really should be providing for and guarding against across their portfolios. We are finding that companies with resilient business models and prudent approaches to risk management are being rewarded through higher multiples. We're also expecting that fiscal stimulus linked to COVID-19 recovery will benefit a number of the sectors that we are investing in. And a global approach is certainly helping in terms of looking for regional opportunities or national opportunities linked to changing policy, and the ability to compare and contrast valuations around the world is certainly helping. Quick summary of our investment performance. So we have continued to deliver well against mandates. The environmental market strategies have done a very good job over the last 12 months against the generic index, the All Country World Index. The sustainable food strategy is slightly behind that, but it does have a slightly different benchmark, given that it's a more defensive strategy and used by clients accordingly. In the sustainable lens strategies, of which global opportunities is the largest component, then again, good performance. We've bracketed here our Pax World funds in a number of areas which are performing much better than they were 2 or 3 years ago. The core bond fund is still slightly behind, but is behaving well as a defensive strategy relative to peers. And then finally, the other strategies which we're bulking at the bottom there include our systematic beta strategies, usually run for US clients. And the performance across the board there is generally in line with, if not ahead of benchmarks for most strategies. So overall, a very good year for investment. We're putting in a few new slides this time just to provide a little bit more detail. So here's a new one on assets under management. So starting at the top left, you can see that the AUM is broken down broadly across a number of different products, with the environmental market strategies being specialists, leaders, Asia, water, and sustainable food, representing, roughly speaking, 3/4 of the assets, or sorry, 2/3 to 70% of the assets, and Pax World funds and global opportunities growing quite nicely. In the top right, you can see the continental Europe is just over half of our assets under management, but the UK has been growing strongly. Bottom right, we are still very heavily skewed towards equities, which remains an asset class where we've still got plenty of growth potential, but also looking over time to be expanding in the other areas too. And then the client type on the bottom left shows a nice spread across the marketplace. The funds we run for BNP Paribas are the largest share by AUM, but represent just over 30% by revenue. And you can see their nice contributions from the other types of clients. So nicely diversified client mix. A bit more detail on channels. This is movement in assets rather than absolute levels of assets. So we've seen very good growth this year in money from clients in the UK and Ireland, with St James's Place and segregated accounts being amongst the highest, or actually both together, the highest areas for growth. The BNP Paribas funds have been growing nicely. That's in the middle. And on the right, you can see in particular that the Pax World funds have had a nice turnaround from negative flows in financial year 2019 to positive flows in the year ending September 2020. Next slide, please. This is a slide that we normally show to indicate the change between the first half and the second half. So for the two columns, which are the London managed strategies and the New Hampshire managed strategies separately, then you can see in the bottom half that market movement was negative. This is in the first half of the year. Market movement turning positive in the second half. But in both the first half and the second half, each of the two groups of funds had positive net flows, i.e. inflows greater than outflows. So solid performance, particularly, or even in the first half when markets were negative. We are approaching the third anniversary of the acquisition of Pax World Funds, which was completed in January 2018. So as planned, we will be buying the remaining 16.7% of that business in January 2021 for a pre-agreed total consideration of $7.8 million. It's possible, but that there will be a little bit of contingent consideration to be paid. The graph shows that at the end of November 2020, the Pax World funds had reached $6.0 billion. If they get to $6.25 billion within the month of December, the next few weeks, then, or by the end of December, then we start paying a little bit of contingent consideration. It's not a binary outcome. It's the start of a sort of rising slope of contingent consideration. So if we did have to pay something, it would be pretty minimal. Business integration is going well. So we have moved towards global teams in most areas. We've integrated our sales teams in Connecticut and Oregon into the New Hampshire team. And we are working hard to consider new product development and further integrating the offerings of New Hampshire with the rest of the business. So although our organic growth is going well, with plenty of capacity in the existing strategies, we are also looking at the potential to launch new products. So this is something we've done very successfully with seed capital from our own balance sheet for the leader strategy back in 2008, 2009, but also global opportunities in 2015. So we do have two new strategies that we are incubating, and subject to them generating attractive track records, we'll be in touch with clients about them. And then our real assets business is also going well. So we're now finalizing the investments for the third fund and considering raising additional capital. As the firm has grown, then of course we have had a number of the standard HR challenges, recruitment, career development, leadership, etc. So we've been spending the last 18 months strengthening our work in this area. So introducing standard management training, rolling out a HR infrastructure, further extending our career development, and working on our culture and values. And I'm pleased to say that staff feedback through surveys has been consistently strong, and we do have very low staff turnover. So investments in people definitely paying off, being the key asset for the company. And a particular focus at the moment, as is happening at many companies, in quality, diversity and inclusion. So we have a cross-functional, cross-team group working on this at the moment. We are implementing projects in recruitment, in benchmarking, and also looking at how we can have an impact on the community, including the asset management community, and to strengthen diversity. Some data on our female representation here, gender diversity being a very strong skill set and an area of expertise that our New Hampshire team have built over the last decade. Next slide. And then just wanted to point out the additional work we're doing alongside investment in policy work. So we've recruited just over a year ago a full-time policy specialist in the UK. We have 2 part-time people, or people working part-time on policy in the US. So not just understanding policy insights for investment management, but also advocating for more depth and breadth to, for example, climate change policy is something that we are finding is benefiting not just our investment work, but also our reputation with clients who like to be associated with such activity. It's strengthening the underpinnings of a sustainable economy. We're also increasingly popular, well known for our work with the companies we invest in, where we're trying to be responsible long-term stewards, critical friends, if you like. And so our engagement work is prized by our institutional clients, as is our impact work, environmental impact, and reporting on it, which we've now done for the last 6 years. And more broadly on thought leadership, then we have been spending some time, money and effort on more recently understanding physical climate change risk, and produced a white paper on that just a few weeks ago.
Great. Well, good afternoon, everybody. I'm going to now take you through the financial items in a little bit more detail, and it's my great pleasure to take you through how the strong flows that Ian's referred to have now led through to significantly increased profitability over this period. Looking at revenue first, we can see revenue has risen 19%, with increases in both London and New Hampshire. And the good news is that by far and away, the dominant reason for that movement is the increased revenue arising on the inflow that we've received over the course of the year, in particular to the London business. And we've also been helped by the rising market over this time as well. Revenue at the end of the period was 87 million for the year on a run rate basis, which means, put simply, the September revenue times 12 months. That would equate to 96 million. And if you were to rerun that number today, noting the inflows and increased assets in the last 2 months, then it would be even higher still. Looking on the right, we can see that how that revenue splits out by geographic domicile of our underlying funds, and you can see that there's very good diversification with no individual location being overly dominant. And finally, on this slide, we can see the weighted average fee margin. And as you can see, there's quite a wide variety of fees charged depending upon the asset class and channel. But within each of those, it's pretty stable year on year. And what we find is that it's really the mix of products sold that affects the overall fee margin rather than anything particularly happening within each of these units. Thank you. If we can turn on. So next we're looking at some trend information. We clearly are a people business, as Ian's already referred to, and that represents our major cost is staff. We've said for a long time that the business is very, very scalable, and this slide attempts to show that whilst we've had the increase in revenues and assets that we've just talked about, we have hired staff alongside that, which is the top left-hand bar chart. That increase of 12% in staff is considerably lower than the rise in revenue, and should also note that the nature of those staff tends to be at the mid and junior levels, and in the support areas, be it client service or control compliance areas, rather than in the core investment team, which you can see on the right, where the number of investment staff is very, very stable, slightly edging upwards, which is likely to continue, but not dramatically so, really demonstrating the scalable nature of our investment engine. So when you compare that to the amount of business that we're doing, you can see on the bottom right-hand part of the slide that there's a significant increase in the amount of assets per investment staff, up 30%, that each of them is managing. So moving on now to the cost slide. Apologies that this looks slightly busy. The reason for that is that we are still at this point separating out the London and New Hampshire business units into two. In due course, this will probably condense down to a combined operation, noting that the business is now very much being run in a fully integrated fashion. But for now, we note that the different components of costs, firstly, the left bar in each case being the non-staff costs, is very stable for both London and New Hampshire, really nothing to talk about there. The fixed staff costs, that salary and fixed staff costs, has gone up in both locations, mostly London, for the reason I just described on the previous slide, which is that we've hired to support the growing business. And then finally, the variable remuneration cost has gone up in line with it being a successful year. So for those that don't know Impax, just a reminder that the Impax London variable remuneration approach is to take a 45% pool of the pre-PRP operating results and create a ring-fence pool, which we then use to pay cash bonuses to staff, equity share schemes for staff, retention and alignment, and then all of the national insurance costs relating to both of those effects are paid for from that ring-fenced amount. So put simply, this rises and falls with profitability, and that's the reason for the change. Anyway, you put all of that together and the operating profit, as is shown at the bottom, has risen 29% from 18 last year to 23.3 this year, really demonstrating the operating leverage that we have within the platform. And on the right, you can see that the operating margin is also rising as we continue to grow. We can move on. In terms of what this means for the earnings, it's quite straightforward from the earnings per share. Nothing much going on other than the rising profits offset by tax, as you'd expect. So a healthy increase in the earnings per share. And in terms of dividends, this time last year, we announced a new policy of paying typically between 55 and 80% of adjusted profits after tax as a dividend. this being the first year of the policy, the board's been cautious in implementing the policy and has determined that 60% is the appropriate payout range, level, noting very strong year, so confident with and pleased with the results, but also mindful that the market conditions do still have a lot of sensitivity to the COVID situation and overall equity pricing. So a little bit of caution within that as well. Plus, we have other needs for cash, which I'll come on to in a moment. Overall, that's produced this big increase in the dividends to 8.6% total dividend for the year, i.e. 56% increase on the prior year. Thank you. If we can move on. So now turning to the balance sheet, the Impax balance sheet is very strong. There's no debt. The main item is cash, which I'll explain. The other items are working capital amounts, debtors and creditors, and items relating to the acquisition of our New Hampshire business a few years ago, so goodwill and intangible assets. So the most interesting item is the cash shown here. We can see that cash has built over the year, primarily due to the very strong cash generation from operations, which you can see at the bottom, after tax, of course. And then during the year, we've paid last year's dividends and the acquisition of shares. So I just pause for one moment. This relates to our employee benefit trust, which makes awards of equity schemes to staff, as I've already referred to. The policy the board adopted some years ago was to use the free cash flow to seek to mitigate any dilution effect arising from these schemes by buying shares in the open market as and when shares become available, depending upon cash balances at the time and alternative potential uses for cash. And over the last few years, that's been successful in significantly mitigating any dilutive effects. It's an option that we have to do. We retain that intention to make such purchases, but it is not a firm commitment to do so, meaning that if we regard it as more appropriate to issue shares for these schemes, then we would do that in the best interests of shareholders. The other interesting item on here is net redemption from unconsolidated funds. That's a long-winded way of saying seed investments. Ian has mentioned that we've had a track record of successfully seeding new products and bringing new capabilities to our clients. Over the course of the year, we redeemed one of those such holdings and reinvested back into another new idea. So a net release of 1 million from those two effects. So the overall net balance of 37 million, which you can see on the right, how we visualize that amount. We firstly earmark a amount for the risk buffer. So as a regulated industry, we need to always keep a balance of cash on hand in case there are sort of issues or concerns. So we take that off first to produce a available cash balance of 25.7, and then we then earmark it for items we are aware of at this point that are upcoming. So net liabilities at the end of September. Over the course of the coming quarter, we need 9 million for that. Further seed investment idea that again was touched upon in Ian's comments, that we're likely to be investing soon, and the final dividend that I've just described, which will be paid next year. So after that, those items, 6.6 million of unallocated cash that we could use for other purposes, such as further share purchases into our EBT, other seed investments or business developments, etc. So that's the balance sheet. So if we can move on to the final of these slides, looking at the shareholder register, I won't take you through the full detail here on the left. I'll have to take questions, however, but in essence, there's 130 million of shares currently issued. And you can see here the effect of share purchase into the trust and the opposite effect of making staff equity awards to staff, and showing that there is a slight current dilutive effect were we to satisfy all of those equity schemes today, meaning that the gross number of shares that we consider is 132. One point of detail is that come January, when we buy the remaining management stake from the Impax New Hampshire management team, we have the option to choose to whether to pay for that in cash or equity. Were we to choose to do equity for some or all of it, then we would be issuing up to a further 500,000 shares. Final point to note on the bottom right is that the overall shareholder register we regard as very well balanced. Our major shareholder, BNP Paribas, our distribution partner with 14%, is by far our largest shareholder. Those that monitor Impax will note that BNP sold 10.5% of the shares they've held for some time a month ago. So this represents the balance after that transaction, and is, to our best understanding, a long-term holding that is very much part of the cementing the business relationship we have with them. Employee ownership of 26.9% combines them with the free float of 59%, which we regard as a well-rounded register.
So just to conclude on the final slide, we do think that after a strong year, Impax is very well placed for the future. Our investment philosophy has strong drivers behind it for the next decade, if not beyond. And the investment strategies that we're running are well established with, in most cases, a good capacity headroom, so plenty more scope for us to grow organically. Our distribution network, combination of direct sales in the UK and the US and distribution partners in most other countries, is well established and produces a nicely diversified stream of set of client relationships and stream of potential new income. And having invested over the years in the different components of delivering our business, we do feel as though the scaling can continue without significant increases in infrastructure. So over the next few years, we will be looking at further product development, as I mentioned, and we do anticipate that with continued robustness in financial markets, there's no reason why we can't continue to expand. Back to you, Andy.
Thank you very much, gentlemen. Very informative, as always. I shall remind people to subject their questions through the Q&A channel. We have a number already, so I shall fire off. Scalability, and there is a compliment here from the questioner in that you have shown conclusive proof of the predictions you made in recent years that you could significantly increase overall assets under management without having to grow internal resource and cost on anywhere near the same velocity. Two questions on future capacity. One seems a very hard one to be precise on, but that is how much you think Impax could comfortably cope with without a significant structural change. Is it 30 billion? Is it 40 billion? And perhaps a little easier to address more specifically is, could you give an idea of the capacity by strategy?
Yeah, thanks, Andy. Can you go back to the final slide, just so we can get everybody focused on those final 67 points?
Yep, you carry on talking, and I'll
yeah, sure. So on that question, then we're not disclosing the capacity headroom per strategy because, to be honest, the numbers do move around. We use quite a we take a disciplined approach to measuring the capacity using liquidity parameters and the underlying liquidity of the portfolio. So we're not disclosing strategy by strategy. In terms of the excuse me, the aggregate capacity headroom, then there's plenty of scope for us to double the size of the business if we were to be able to bring in money wherever we wanted. Some strategies, for example, in the more specialized areas like sustainable food or Asia environment, do have limited capacity, typically £1 billion or so of additional headroom each. But there's the scope if we judiciously launch new strategies and continue to perform well with institutional quality processes and client service across the board. There's no reason why we can't double the size of the business without launching into new asset classes.
Okay. And in terms of developments, we have a request if you could just say a little bit more about the new Asian Opportunities Fund.
Well, our work in Asia has now got a 13-year track record. Our team in Hong Kong, so we've been investing in the Asia Environment Fund for over a decade, and the pipeline of new investment ideas coming out of China, coming out of the ASEAN region, coming out of Japan and India is very healthy. So we are continuing to grow that Asian environment strategy. It is something that we would aspire to aim for is a more broadly defined Asia product. So we're considering whether there's scope for another more broadly defined Asia strategy. We haven't launched or announced anything like that, but we are considering it. So I'm not quite sure of the origins of the question, but I think that's the best way of tackling Asia.
Mm-hmm. A couple of questions, I think, just seeking clarity on BNP. It's a very long relationship, so I presume that you have never had too many fears that insourcing of the assets that they're contributing is a threat. But if you could give a little more detail on the new agreement that you've struck, that would be helpful.
Well, the relationship goes back to 2006 when we first started to manage one of the strategies, our specialist strategy for BNP through a BNP Paribas fund, and they bought their stake in 2007, at which point we signed a memorandum of understanding, which has been the basis for the distribution arrangements over the last 13 years. So the reason for cementing that in a more legally binding and slightly more detailed distribution agreement was that both parties realised that there was not much legal underpinning to the partnership that had produced great commercial benefits to both parties, as well as some great benefits to clients over that time period. So the distribution agreement really doesn't do much more than memorialise and put a stronger legal underpinning under what's there already. So essentially, BNP Paribas has exclusivity to market our 5 environmental markets or thematic equity strategies in a number of countries, particularly in countries in continental Europe. But Impax is not restricted in marketing the other strategies in those countries. There is some language around how we collaborate with regard to multinational clients, for example, global private banks, where there is scope for confusion and sort of cross wires given the multiple entry points of those groups. But the fee basis is not changing for the products, and the modus operandi in terms of the nature and the frequency of the interaction isn't really changing substantively. What are BNP Paribas Asset Management long-term intentions? Well, I think they've stated that very clearly in the release that they put out at the time of the shares. They do see themselves as a core strategic long-term partner to the firm. They have realised some profits given that they bought their shares at around 35 pence. So they've seen a very nice capital gain on that money. And in selling down from nearly 25% to 14%, then they are still our largest shareholder, as Charlie said. So we don't expect them to be looking to sell any more shares, even after the lockup period, which they were obliged to put in place given market rules.
Thank you. And St James's Place, which appeared as one of the source in the good performance of UK growth in assets. Could you comment if that arrangement is going better or as expected from your point of view? And are you getting any feedback from their advisors about the growing interest in sustainable investing and therefore the enthusiasm for the venture going forward?
Yes, I'm sure for those that have heard us present before, you'll remember that St James's Place picked up the Global Opportunity Strategy in late 2017, early 2018 as a result of their global search for a sustainable and responsible investment manager, which was the first such manager that they hired. So we have helped them to migrate their product range in the direction of the more sustainable economy. I think they have been very pleased with the level of client interest, and their partners have a lot of demand for this particular fund. And so that fund has been growing very nicely. I would say the relationship is really to summarise the results for both parties as surprising on the upside, And I would say that the potential looking to the future is very significant. So in the first 2 months of this year, we've seen very strong inflows from Japan. Part of that, £1.9 billion of net new cash, but also strong inflows from St James's Place as well.
Thank you. Now we've had 2 or 3 questions about ESG that I'll try and roll into one, whilst obviously recognising that you are specialists in sustainable investments. It's a slightly different kettle of fish. One relates to the competitive environment, and another viewer has helpfully pointed out the recent Morningstar survey on ESG, which showed a very clear differentiation between specialists such as yourselves and Stewart investors getting a very high rating, but some of the global giants of the scale of Vanguard and Fidelity being branded more as playing the momentum than being experts on it. And following on from that, presumably that then becomes an important factor in your competitive advantage if you do have to tender for a piece of business. I realise a lot of these are on long-term relationships. So if you could just summarise those points about the value of being a specialist and being experts in the space.
Yes, I think it's helpful to think about our market opportunity in the context of 2 types of allocation: the specialist or thematic allocation to, for example, our environmental markets product range, and separately the more core or non-thematic allocations, for example, to global opportunities. In the first area, then there is a limited amount of competition with the depth and breadth of experience that Impax has, and we find that we're in a very strong competitive position as a result. In the second area, then of course there's many hundreds, if not thousands, of managers who are offering equity or global equity type products, and so we are facing much more competition of managers who have got some kind of story or offering which would include ESG or something similar. And there, I think we are very confident that when the clients or intermediaries and consultants look under the skin of what's going on, that they see a very authentic offering from Impax, strength and depth in our team, a very well through and documented investment process, and some great well understood track record numbers, as well as non-financial outcomes around, for example, environmental impact reporting. So the net result of that is that we are confident that we'll continue to have a competitive edge, even in the more generic marketplace, as competition builds. But at the same time, we do need to remember that investment management is fiercely competitive, and we need to continue to invest in our thought leadership, in our impact and engagement work, and in our policy and advocacy work. So certainly not sort of sitting on our hands.
And perhaps to finish with, again, a merging of questions around measurement in a different way. One again relates to ESG and evaluation of your credentials by score charts, which I think you've probably just covered. But on a more of a level as regards environmental impact, are you seeing an improvement and an escalation in measurement of climate change and climate risk? Is it becoming more sophisticated, and is that in turn allowing better estimation of positive impact that can be made?
This is certainly a very fast-moving landscape. So for those who've got some knowledge about it, there is increasing commentary, if not pressure, from regulators as well as from asset owners for asset managers and companies to identify, quantify, and report on their risks and their results, so impact in these areas. I would say that there's huge scope for confusion, for example, around climate change risk, where there's a large body of individuals or institutions calling for carbon footprinting as a proxy for climate risk, which in our view is somewhat misguided because it doesn't take account of directly of the potential for balance sheet and cash flow to be impaired. And also the absence of standards and metrics is a bit troubling because it does mean that there's a likelihood of a lot of time, money and effort, particularly by corporates active in creating impact in gathering and producing data, which is not necessarily going to be used by those who are asking for it. So we're calling for decision useful information, we're calling for convergence and standards. Having said that, this whole area does, through its complexity, give us an opportunity to have a meaningful and insightful conversation with clients and prospects, and does give us an edge relative to some of our peers. So we're trying to sort of turn the confusion to our advantage in terms of market profile.
Okay, and thank you for that. And we've had one late question, which I think can be expanded on from someone who joined a little bit late. So, one of the key drivers of optimism for the future, you've already mentioned that the change in the US administration, and if you could just let us know whether in your presence there or advisory committee, you have some insight as to policies that may accrue and be beneficial coming out of the Biden administration. Obviously, a stark contrast with Donald Trump's view on energy and emissions, et cetera, But any insight you can draw on from your American operations would be welcome.
Yes, I think it's relatively early days in terms of detail, but what looks to be almost certain is that the US will rejoin the Paris agreement in January, i.e. next month, when Joe Biden becomes president. It's also very likely that the rollout of drilling permits on federal land for shale gas will stop and potentially be reversed. There'll be tightening up on fugitive methane emissions from industry, excuse me, and the public sector where relevant. There will be a restoration of the corporate average fuel efficiency standards for the US vehicle fleet, and we'll be back towards more efficient vehicles. And there's a likelihood that the clean power portfolio regulations will be restored or reinstated. So the details of those ideas have not yet been published to my knowledge, but we're certainly very optimistic that there'll be a strong focus on environmental quality and also on creating jobs and economic value in the clean economy from the new administration.